Well, yeah, I mean, it's interesting. We've seen quite a few good results, this morning and over the last few days, and I think we're seeing good numbers coming out, even though we haven't really reached the economic recovery yet. We yet to hit that. I think a lot of markets have certainly got very excited about expectations of recovery, and I think certainly in many cases stocks have sort of run away on hopes that the recovery is coming. So it's a bit of travelling and arriving. I think it's certainly going to be good. I think typically in periods of recovery, you do get an underestimation of the impact that it has on corporate earnings. And the last year we've seen companies retrench, they've cut costs. So when sales do start to rise, you do get the operational gearing coming through and some very good numbers. And certainly, I for one, I think economists are probably underestimating the scale of the recovery in GDP we can expect in the UK in particular, also probably in Europe and the US. And I think there is an upgrade to forecast coming, but as you've indicated, how that translates into markets is less certain, because historically, good economic performance doesn't always translate into good stock market performance, and certainly we've seen. You look at the graph of the S&P stock market over the last 12 months, and you think sort of, well, pandemic, what pandemic? It's been a phenomenal performer. So there's a lot of good news baked into prices, and we're seeing lots of signs of excess emerging. So good results. I think those are set to continue, but how that manifests itself in share price performance, I think it could be a little bit more muted.
David, that is a good point about the rear view mirror versus what is ahead for investors at this point. How are you positioning then?
Well, I think equities, I think we're still sort of moderately constructive towards equities. And if you look at the world index, I think it's around about half the MSCI world index is in bear market territory, about 20% off its high. So there's still areas of value out there. But I mean, I'd point you to areas of excess. And we've witnessed huge monetary expansion over the last 12 months. Central banks, quite rightly, engaging in QE, pushing money into the system, keeping interest rates low, supporting the economy. And the impact of that has been to create bubbles in certain areas. And examples I point to, the rising cryptocurrencies and Bitcoin, the enthusiasm for the listing of SPACs on stock market exchanges, GameStop's another one. And there's a variety of areas that we're seeing it set. You look at some of the sort of so-called stay-at-home stocks listed in the US, Amazon, Microsoft, Apple, Google, Facebook. If you add up the market cap of those companies, I mean, it's worth more than the aggregate of all the emerging markets, which serves about 6 billion people. So, there's a lot of enthusiasm for some of these companies, and a certain amount of risk. So, whilst I still think, given where we are, given the ongoing support for markets from monetary policy, I think equities will probably stay up and may continue to drift higher. But I think you just need to exercise a degree of caution, be a little bit more selective about where you're putting money.